Did you see what the Federal Reserve just did? This is going to help homeowners, home buyers, realtors, loan officers. No, it's not that they cut rates. It's not even the dot plot. It's the bond market versus the bills. What am I talking about? Well, in today's video, it's quantitative easing time. Yes, the Federal Reserve is back and they are going to buy Treasury bills. Is that good news? Bad news? What in the heck's it going to do to those over there? So if that's your question, my name is Dan Frio. I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. I'm here to explain those to you and the effects that it'll have onto these. It was a little bit of shocking information, so let's get over to the news. So here's what happened. The Federal Reserve came out today and they did cut rates a quarter point, and that wasn't what shocked the markets. They did come out with their new dot plot, and yes, this is what the dot plot looks like, but that's not what really affected the markets today. It's the difference between the bond market and Treasury bills. Why is that so important? Well, here's why. Have you been looking to refinance and you're like, okay, I'm at 7% and 6% would be good, 5% would be even better. Wonder if you were the federal government and had trillions of dollars in debt and you could maybe refinance that debt at a lower rate. That's actually what happened today. And I'm going to show you how that's going to have great effects to mortgage rates coming probably in the next few months, if not tomorrow. So let's get to the first piece of the puzzle we have right through here. The Federal Reserve, they cut rates a quarter point. They came out and said with their dot plot that they're expecting one more rate cut next year. There was supposed to be multiple rate cuts, but they gave us the dot plot today, and here's basically what it tells us. It says the majority of members, they're voting right through here, voting to keep rates basically where they are right now. So this is what a dot plot looks like. Basically, the Federal Reserve members, they come in each year and they put a dot next to where they think the federal funds rate's going to be. Well, right now the federal funds rate is 3.5 to 3.75. That's right where we are now. Well, most of the participants are saying, well, we're most likely going to be there next year. Well, we're going to have a whole new cast of characters at the Federal Reserve coming, basically by next May, we'll have a whole new cast of characters. We have one person that's going to retire early. That's, I think, in February. That'll replace another Trumper. And then we have the federal chairman. He's going to step down. I think he can actually step into a governor's role. I think he's just going to say, I'm off, and I just off into the sunset. So we're going to have another person that's, say, appointed by Trump, and I think we just had another one or two. It's going to be filled with Trump officials. So you know the Trump administration is pro-real estate. They are pro-mortgage rates or lower rates. So where are these going to go in the future? Well, here's where the bill and bond thing comes into play. Here's what we look at each day. Remember, we come in and we watch the bond market. Well, here's what happens. When the government doesn't have enough money, and they don't have it because we're $38 trillion into debt, they actually have to finance that money, and they usually finance it with Treasury bonds. Okay, and here's the 10-year Treasury yield, and even on the 30-year yield, I think it's a little bit higher than that. It might be teetering on about 5%. So imagine if you can refinance all that debt, you're talking trillions, into a rate that's much lower. Well, that's what the Federal Reserve or the federal government's been doing lately. So what they've been doing was kind of intriguing, and I never realized what their goal here was, because I'm like, okay, you're putting a lot of weight on where mortgage rates and interest rates are going to go in the future. Here's what I'm talking about. The federal government lately has been issuing Treasury bills instead of Treasury bonds to finance their debt. Well, the risk there is every year or two, you have to refinance that debt. Imagine if you're a homeowner and you had to refinance every year or two, and it didn't depend on where mortgage rates were or interest rates were, you had to refinance. Well, that's what happens with if you start refinancing all this debt on Treasury bills, because a Treasury bill is a short-term, basically instrument, where the Treasury bond is longer term, like 10 years and 20 years. So they're refinancing everything short-term. So there's a risk there that if rates do trickle up, well, it's going to be detrimental to our national debt. But as long as the administration's in place with all basically the people at the Federal Reserve, they're going to keep rates coming down and down, at least sticky. We'll put it that way. So my expectations are where rates are going to go from here are going to change a little bit, and I'll come out with my forecast here in the next week or two. But here's our national debt. Yes, it does give you a little bit of a scare, though. But here's how these rates work. Here's the current rates on the Treasury bills. You get a one-month Treasury bill right now at 3.8%, a 6-month at 3.7%. Look at the difference between these yields. Down through here, you're looking at rates almost at 5%. So a good difference there, especially if you're talking trillions of dollars. I wonder if you're a homeowner right now. No, you don't own trillions of dollars, but does a refinance actually make sense for you? Well, let's let's get over to here to my website real quick. And like I was saying, folks, my name is Dan Frio. I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. I've been doing this for over 35 years. I'd love to help you. If you're a homeowner right now, we created a tool right up through there. It's called RateWatch 2.0. What you do is put in your mortgage information, then let us know what interest rate you'd be interested in refinancing. What will happen is I'll call you, I'll text you, I'll email you. We don't sell the data. So the first thing we want to go over is the PCE inflation. You guys know my take on inflation. I think oil and tariffs are going to help this tremendously, and this thing that they did at the Federal Reserve today was genius. So I think it's going to help inflation tremendously. On the unemployment front, I think as long as companies start to get a little bit more comfortable with things, remember we got that big beautiful tax bill coming next year. It's going to help put a little more tax money in our pockets for the average consumer to spend. So that's going to help there, and that's also going to help on the GDP. So the rates, I think they're going to be sticky. I'm going to come out and say they're probably going to be about 5.875 to 6.25. I will be coming out with my projections soon. So if you're like I said, if you're a realtor, you're a loan officer, you need to explain these to your clients on how this is going to affect rates. But the biggest thing you want to talk about is the national debt, because that's what was raising rates, everybody was saying. But now this genius move by the Fed of quantitative easing to buy Treasury bills, I think it's going to help homeowners and home buyers quite a bit. So a little confused on this, a little bit confused on how to maybe buy or refinance your home. Well, join me each day. Subscribe over there. So every day I come out and I explain to you guys what's going on with mortgage rates. We also go over mortgage programs to help you understand more and more about financing when it comes to real estate. So folks, my name is Dan Frio. Hopefully you learned a little bit something today about the how mortgage rates work, how the Fed plays a role in this, and how the Treasury bonds and bills play a major role in where mortgage rates are going to go from here. Thanks for watching. Come back tomorrow because we're going to see how the dust settles and where mortgage rates open the day. Thanks for watching. Don't forget to subscribe over there, and I'll see you tomorrow. Bye-bye.